Stop looking at the Bitcoin chart right now. You're focusing on the price, and it's blinding you from the real event. The number one risk you face isn't the price falling. It's your access to Bitcoin at today's price being structurally and permanently erased. Here's the fundamental truth. Bitcoin doesn't rise, it gaps. It jumps vertically in an instant when the last seller at a given price vanishes. Most people watch the price. You need to understand the plumbing. We've all seen it, that single monolithic green candle that looks like a glitch, a 20% move while you slept. By the time you see that candle, it's already too late. You've been left behind. The price you were waiting for, the perfect dip, it may never come back. Today, we are dissecting that exact moment. I will show you the on-chain data that reveals how the trigger for these explosive moves is being primed right now, why you are being psychologically conditioned to miss it, and how understanding this one concept, the supply shock, is the only edge that matters. Let's talk about the market in March 2026. If you feel bored, anxious, and confused, you're supposed to. After hitting a staggering new all-time high of over $126,000 in October 2025, we've corrected hard. Now, with Bitcoin chopping between $67,000 and $71,000, it feels stable, predictable. This is a dangerous illusion. These quiet periods are where fortunes are lost. They lull you into thinking you have time. I'll buy the breakout, you say. I'll wait for one last dip. This is where most people get this completely wrong. Because what you're watching isn't a stable market. It's a market running out of sellers. It looks like balance. It feels like indecision. But underneath, something irreversible is happening. They see this sideways price action as a fair debate between buyers and sellers. It is not a debate. It's a slaughter. Most people don't even realize they're losing. Beneath that flat price, a war is being waged. On one side, the exhausted sellers. They're tired, scared, and psychologically battered by the drop from the highs. They just want the pain to stop. On the other side, the silent accumulators. These are not retail traders. They are disciplined, patient institutions and whales, methodically absorbing every single coin the sellers can give up. They are a sponge, and the price on your screen is just a mirage. It only shows the last transaction. It doesn't show you the war. It doesn't show you the sponge soaking up every last drop of available supply. What happens when the sellers just run out? That's when the price doesn't adjust. It snaps. The price doesn't walk up the stairs. It takes an express elevator straight to the penthouse, skipping entire floors. One moment it's $71,000. The next, it's $78,000, with zero chance to buy in between. This is a historical fact. Remember the break of $20,000 in 2020? The path to $30,000 was a blur. There wasn't time to think, only time to regret. The market is designed to make you too late. Let's make this personal. You've watched the price chop sideways for weeks. You're waiting for clarity. It seems like the smart thing to do. You have a perfect entry in mind, maybe a little lower. Or you're waiting for a breakout above resistance, say $75,000, for confirmation. Then one morning, you wake up. You check your phone. A cold dread washes over you. Bitcoin didn't just move, it left. It's up 12%, trading at $80,000. It didn't just break the resistance you were watching. It shattered it in a single green candle while you were sleeping. No dips, no retests, no opportunity. Now, a new anxiety kicks in, the frantic, desperate fear of missing out. The price you called too expensive yesterday suddenly looks like a generational bargain. Every tiny pullback feels like your last chance. So you finally buy, 12% higher than you could have just 24 hours ago. You've just become exit liquidity for those who understood the game. This gut-wrenching regret is a core feature of the Bitcoin market. This is the moment the market punishes patience. The very act of waiting for confirmation is what ensures you pay a higher price. This current consolidation is where sellers are at their most vulnerable. The news is negative. Sentiment is fearful. This is seller exhaustion. They sell not because they want to, but because they feel they have to. And they sell directly to the patient accumulators who know this is the final act before the price snaps. They sell to the people who understand that the moment the last of these sellers is gone, the market becomes a vacuum. So what is the trigger? It's not a lagging indicator on a chart. It's a fundamental state of the market: total seller exhaustion. This creates a liquidity vacuum in the order book. Imagine a staircase. In a normal market, there are steps at every price. To go from $70,000 to $71,000, buyers have to clear hundreds of small sell orders. But in the market we're describing, those steps are gone. There's a cluster of sellers at $70,000, but the next significant group doesn't appear until $78,000. That space in between is an air pocket, a vacuum. Now, what happens when one large buy order absorbs the last bit of supply at $70,000? The price cannot go to $70,001. There are no sellers. It doesn't walk. It doesn't climb. It teleports instantly to the next seller's ask, leaving a black hole where your buy order was supposed to be. In our example, it gaps straight from $70,000 to $78,000. Price is simply a search for liquidity, and when liquidity disappears, price doesn't negotiate, it jumps. When there is none, it moves violently. And we have on-chain evidence that this setup is happening right now. First, the Great Supply Shock. A direct way to measure sellers is to look at Bitcoin on exchanges. We are witnessing an unprecedented exodus. Data shows exchange reserves have plummeted from over 3.2 million BTC in 2023 to a range of 2.4 to 2.7 million in early March 2026. That is an army of potential sellers literally leaving the battlefield. Second, the institutional avalanche. Who is absorbing this? Institutions. Analysts have noted periods where demand from vehicles like ETFs is massively outpacing the new supply from miners. For every one new coin created, multiple coins are being bought by the biggest players in finance. They are systematically cornering the available liquid market. This is the trigger. Dwindling exchange supply plus relentless institutional buying creates the air pockets. The market feels heavy, but underneath, the floor is disappearing. And most people won't see it until it's already gone. This isn't theory. We can see this pattern play out historically and right now. Case study 1, the macro squeeze. Exchange balances versus price. Picture a chart. Bitcoin's price is chopping sideways for months. Below it, the line showing Bitcoin on exchanges is in a sharp, undeniable downtrend. For a while, nothing happens. This disconnect is the market's most dangerous lie. The downward slope of reserves is the tension building. The flat price is the market's ignorance of that tension. Then, the exchange reserves hit a critical low. The sellers are gone. The price line suddenly goes vertical. It's not a rally, it's a repricing. The price is catching up to the supply reality the on-chain data predicted months ago. That flat price wasn't peace. It was the sound of a fuse burning. And right now, in March 2026, exchange reserves are hovering near multi-year lows. The spring is coiling. If you are getting value from looking at the plumbing instead of just the price, take a second to hit that subscribe button. It tells us you want more of this data-driven analysis that cuts through the noise. So I'll give you a second to subscribe. Case study 2, the historical precedent, the break of $6,000 in 2019. For those in the market in 2019, the agony was real. Bitcoin was stuck under a wall of resistance at $6,000 for months. But while the price was stuck, on-chain data showed coins were quietly moving off exchanges. The order books were hollowing out. Then, in April 2019, a single aggressive buy order, rumored to be worth $100 million, was the trigger. It absorbed the last layer of sellers. The result was a classic liquidity vacuum. Bitcoin didn't just break $6,000, it gapped, jumping hundreds of dollars in minutes. This kicked off a rally to nearly $14,000 in 2 months, leaving anyone waiting for confirmation in the dust. Case Study 3. The current setup. March 2026. Now, apply this to today. The market is showing every sign of seller exhaustion after the major correction from the 2025 all-time high. Yet, what is the smart money doing? On-chain data suggests wallets holding 100 BTC or more have increased by over 750 in the last 3 months. They are accumulating into the fear. At the same time, the exodus of Bitcoin from exchanges continues. This is the setup. You have sellers capitulating from boredom. You have large, patient buyers absorbing everything without spiking the price. The order books are hollowing out. We appear to be building a massive liquidity vacuum right under our feet. The question isn't if a trigger gets pulled, but when. The core takeaway is this. The most violent moves in Bitcoin do not give you time to think. They are not polite. They are a structural failure in sell-side liquidity, and they happen in an instant. When that trigger is pulled, the game changes. The move from $71,000 to $78,000, or from $80,000 to $90,000, can happen in a single day. By the time it's breaking news, the move is over. You are left with 2 terrible choices. Chase the price at a permanent disadvantage, or sit on the sidelines, defeated. This is why you must reframe risk. Most investors obsess over price risk, the risk the price goes down. In this market, the far greater danger is access risk, the risk that you won't be able to get Bitcoin at a fair price at all, because the supply at that price has simply ceased to exist. The data is clear. Exchange balances are at historic lows. Institutional demand is relentless. This isn't speculation. This is an accounting reality. The liquid supply of Bitcoin is being systematically taken offline. Your edge is not in predicting the exact day. Your edge is in understanding the mechanics of the breakout before it happens. It's recognizing that these quiet, frustrating periods aren't a time for complacency, but for preparation. You have to position yourself before the silence breaks, because when the music starts, it will be too loud and too fast to think. The biggest moves don't announce themselves with a trumpet. They arrive in the deafening quiet of an empty order book. When you understand that Bitcoin's price doesn't always climb, it gaps, you see the market differently forever. You stop waiting for permission from the price, and you start listening to the data. If this analysis gave you a new lens to view the market, do me a favor and hit that like button. It helps the channel immensely. And for more deep dives that separate the signal from the noise, make sure you are subscribed with notifications on. I'll leave you with this. Understanding this supply shock was phase 1. But what happens when this institutional avalanche becomes a global stampede is phase 2, and the rules of the game will change all over again. Look at the data. Do you see exhausted sellers ready to fold? Or do you think they have one last fight left in them? Let me know in the comments below. Let's discuss.